This is Matthew Cratter from Bitcoin University, and today I wanted to talk about how forked the Fed is. Basically, what happened in 2020, we had this huge government deficit spending that was monetized by the Fed, and this is a process in which the U.S. Treasury issues bonds to pay for all of the out-of-control government spending that taxes are not covering, and then the Fed buys them with freshly printed US dollars. We started off with the Fed saying that inflation was transitory, and then we reached the point by the end of 2021 where both Jerome Powell, who's the head of the Fed, and Treasury Secretary Janet Yellen were saying that it was time to retire the term transitory when discussing inflation. As a result of that inflation, the Fed was forced to raise rates very sharply and very quickly in 2022. We can see going from basically the zero bound up to 5%, completing the final hike just this week. But by raising interest rates so quickly and unexpectedly, after keeping them so low for over a decade, the Fed succeeded in blowing up the balance sheets of U.S. banks. And you're seeing a lot of this on the news, obviously. These banks hold a lot of U.S. treasuries and mortgage-backed securities. This is what banks do on the asset side of their balance sheets. And so when interest rates go up, these bond prices go down, government bonds and mortgage-backed securities, which are bundles of, for example, your home mortgage combined with other people's mortgages and put into a security. When interest rates go up, bond prices go down. So all of a sudden you have most U.S. banks being technically insolvent because the asset side of their balance sheets has fallen so much. And we've had this string of bank failures, some of it perhaps intentional to go after crypto, but Silvergate, Silicon Valley Bank, Signature Bank, First Republic Bank, PacWest Bank teetering on the edge this week, Credit Suisse, for example, as well. The whole U.S. banking system is now technically insolvent, and many other countries' banking systems presumably as well, thanks to the Fed. So this is what the Fed did. They started the fire, then they blew up your house trying to put out the fire, then they come by and they offer to patch up your burned down house. This is why we don't really need these central banks. They create a lot of volatility and a lot of unnecessary pain for people. Now, having interest rates on treasuries remain higher than most bank savings accounts has also led to a slow motion run on the banks as depositors seek higher yields. So they're pulling their money out of banks and putting it into money market funds, which have a higher yield, or even U.S. treasuries, T-bills, or two-year notes, for example, sort of short maturity treasuries, rather than keeping their money in the banks. And then this puts even more pressure on banks since they may be forced to liquidate assets at a loss. These treasuries, for example, or mortgage backs, which have fallen sharply because of the interest rate hikes, they may be forced to liquidate these assets at a loss in order to give you your money back. And again, this is a loss to the bank, not necessarily a loss to you unless you have a true run on the bank and you have more money in there than the FDIC limits. Now, if enough people move out of a bank run ensues, and panic begets more panic at other banks. And this has really been what a lot of 2023 has looked like. A couple of months ago, the Fed was forced to put out the Bank Term Funding Program, BTFP, which allowed banks to turn in their treasuries to the Fed at par, even though they had fallen on a mark-to-market basis. So basically, this was the Band-Aid that the Fed was forced to apply. But I would say here in the direct context of Fed monetary policy, here are three signs that you cannot hike interest rates any further. You just blew up the whole banking system. You just blew up the whole U.S. banking system. You just blew up the whole banking system. So that makes it pretty difficult to raise Fed funds above where CPI levels, consumer price inflation levels, are currently. Now, CPI could fall, but at least for now, it's very difficult to raise rates to get them above where CPI is, which is what you need to do to have truly tight monetary policy. And we'll see where CPI is at the next report. It's a highly massaged number as well, so it's hard to know how much trust to put in it. So the market is currently pricing in a very low probability of more rate hikes. If we take a look at Fed funds futures, we can see here for the June meeting, the June 14th meeting, there's call it a 96% chance that the Fed stays at 5%. In other words, 5 to 5.25%. That's where the current target rate is in that range. There's only a 4% chance or 3.9% chance that they hike 25 basis points. Before the very strong jobs report this morning, this was basically at zero, but now the market's pricing in a very, very small probability that the economy remains robust and rolling ahead and inflation remains elevated. And so the Fed has to hike even at their June meeting, but the consensus still is, the probability is still very, very high that they do nothing. And then if we look ahead for the July meeting, we see approximately 59.5% chance they don't do anything. They stay at the same target rate. There's a 38% chance that they actually cut 25 basis points, and then there's, call it a 2.3% chance that they hike. So the market seems, the consensus seems to be that they stay where they are, that they're done, and there's a small probability, or a not insignificant probability of 38% that they cut in, for example, if the banking crisis continues to get worse. So here's the big problem, and this is why the Fed is so trapped. We're still in this structurally high inflation environment that's caused by a number of factors coming together: deglobalization, some of the knock-on effects and things that are left over from the pandemic, breakdown of global petrodollar consensus, massive, and this is a big one, massive government deficit spending, including the coming wave of entitlement spending, Medicare, Medicaid, Social Security, etc. If the Fed starts to cut interest rates in a structurally high inflation environment like this, official CPI inflation and true inflation will absolutely skyrocket again. So they can't cut rates, but if they keep rates high, the banking system will remain insolvent. Bank failures will continue. And tax revenues, this is very important, tax revenues will continue to plummet because no one has capital gains when stocks and bonds and housing prices are all down. And this is a huge percentage of tax revenue. And it's also, obviously, the stock market is tied to the way people spend their money and basically domestic consumption as well. Now, if tax revenues remain depressed, you at the U.S. government will either have to rein in spending, which they're probably not going to ever do, and in this case, that would involve cuts to retirees, which would be very politically unpopular and very difficult to push through. The U.S. government will either have to rein in spending or issue even more debt to pay for the spending, and this is where they run into trouble. I've shown you this chart many times, debt as a percentage of GDP. This is a good way of thinking about, can the economy service this amount of debt? Now, the U.S. government can keep rolling over its debt. When the debt matures, presumably it can issue more debt to pay off the old debt, but there's also this issue of having to service the debt, and at what interest rate that gets serviced. It's currently at around 5% on much of the curve, and so that makes it very, very expensive for the U.S. government to service its debt. And whenever countries get above 120%, call it, or even 100%, they begin to run into problems. And this is, of course, what we've been seeing since 2020, where debt levels hit 134% of GDP. They've come down a little bit thanks to the inflation we've been having, but they're still very structurally high, this ratio. And this is one reason that the Fed has blown up so many things on their path to raise interest rates, and they're tightening. But the debt situation is actually much worse than this chart shows. This chart shows us at about 120% debt to GDP. You don't have to trust me on this one. You can listen to Stan Druckenmiller. Great speech by him the other day. Stan Druckenmiller was one of the lead portfolio managers for George Soros at the Quantum Fund, and he also had his own hedge fund after that, one of the most successful investors of all time. And so you should definitely listen to him when he talks. I wanted to quote from this speech where he's warning about the U.S. debt crisis and how it could be much worse than people think. I believe this conference was held in L.A., so hence the Santa Monica Pier analogy here. But here's some quotes from his speech from Stan Druckenmiller. All this focus on the debt ceiling instead of the future fiscal issue, which he's talking about entitlements and Social Security, for example, is like sitting on the beach at Santa Monica, worrying about whether a 30-foot wave will damage the pier when you know that there's a 200-foot tsunami just 10 miles out, in this case, call it 5 or 10 years out. The big issue is entitlements such as Social Security, Medicare, and Medicaid, which, without cuts today, will have to be slashed in the future, he said. In the speech, he expressed concerns about the Biden administration's plans to deal with the potential shortfalls, as well as the lack of fiscal restraint by the Republican Party. We saw this under Trump as well, running $1 trillion budget deficit right at the beginning of his term. So it's really both parties who are total pigs when it comes to government spending. Spending on seniors, again, this is a quote from the article, spending on seniors will reach 100% of federal tax revenues by 2040 based on Congressional Budget Office estimates. So this is by the government's own estimates, probably sooner, Druckenmiller said, including interest expense. What's more, the current $31 trillion U.S. debt load, which is what we saw in this chart, what's more, the current 31 trillion U.S. debt load doesn't account, here's the important part, does not account for future entitlement payments. Accounting for the present value of that burden, the debt load is more like 200 trillion, he estimated. So that obviously drives this chart just completely off the chart. And these entitlements, they're off balance sheet debt, and they will need to be paid for at some point. So they're a true liability of the U.S. government, even though they're not included in this debt to GDP chart. So what I think is going to happen is the money printers are going to have to come back on. This is the only path, unfortunately, that the U.S. can take. It cannot take austerity. No one is going to go without their entitlements. No one's going to go without. So many people in the U.S. are dependent on the U.S. government at this point with all its programs. It's got its tentacles everywhere, and it's impossible to imagine it really scaling itself back. What it's going to do, it's going to keep growing, and we're going to inflate our way out of this mess. Unfortunately, inflating your way out of messes can be quite ugly. We've seen this year numbers coming out of Argentina north of 100% annual inflation. As this article points out, it's very, very hard to save in that capacity, unless, of course, you're shielded by Bitcoin. Here's a very interesting chart of Bitcoin denominated in Argentine pesos, and we can see, in spite of the fact that, at least for people who sort of think in US dollars or euros, that Bitcoin is down in fiat terms. In Argentine pesos terms, it's hitting new all-time highs. It's surpassing the highs from November of 2021. So this is one nice thing about being in Bitcoin. You benefit not just from increased adoption, increased usage of the system, but you also benefit when your fiat currency goes to hell, and you have this sort of protection. So it's not a direct hedge against CPI inflation. As we've seen, it can move around relative to that. But when you really need your savings to be protected, Bitcoin is the place to be. And people in Argentina who are experiencing this terrible inflation, those who are holding Bitcoin or even US dollars, are obviously doing much better than the general populace. This is the very stark choice that the Fed is faced by. Do you keep rates really high and continue to blow things up, or do you eventually turn the money printers back on? My bet is that they have to turn the money printers back on. And as a result, we're going to be experiencing very, very high inflation in the U.S. over the coming 5 to 10 years. I don't know if it hits 100% like Argentina. It's certainly possible, though, if faith in the system completely breaks down. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks all for watching, and I'll see you in the next video.